Hey everybody, this is Paul doing a video on the day that the market's closed right now, April 15th. Just going to do a quick portfolio overview, my thoughts on the market, obvious changes to my sheet here, obvious changes to my positions, which is not too big if you really think about it, but I'll show what I'm up to with this. And then just kind of my thoughts on the market, where I think it's headed, that kind of thing. So I guess first things first. What's going on with my sheet here. So what I did is I restructured my sheet to have I guess you can call it a monthly dividend bill payments kind of thing. So this is basically, so I have other sources of money that are coming in from, like, say, my spouse working or whatever. But this is basically money that comes in, and the bills that would, like, what stocks or what ETFs would cover which bills, just to kind of get a general idea of like where I'm at, that kind of stuff. So this is just a general idea, like, when the bills normally come in, what I estimate that they might be, and what would cover what. It's effectively this chart up here that I've had for a while on every single video, just broken out into kind of like, okay, so, and anybody can do this, is like if you're ever thinking about like retiring or whatever, like, what would cover actually, what would cover what? How would that realistically happen if you ever really did try to retire? Like, what would cover what? So it just gives a general idea. And then obviously, basically everything outside of this would basically either, go towards gas, food, reinvestments, that type of thing. So right now, so where did this 11,772 cash balance come from? So basically, I got rid of every investment that was not a like a monthly payer, basically, effectively at this moment. Um, Normally in the old days, if I did a move like this, I would have redistributed the money into different things like Verizon, for example, Walgreens, Pepsi, Coke, that kind of thing. But we're kind of running into a problem. So that's why I wanted to kind of show this chart. So this is a chart that's been floating around. This guy right here. This is just where I found it. So this is like a CNBC guide. And this was a chart that was floating around a few days ago. And what this chart shows is there's certain trend lines that have been going on for 40 years or so, ever since the 10-year rate, for example, hit its high, way back when, right? When they raised rates the last time they were battling inflation. So what's going on right now is that the Treasury yield curve, as they call it, has been in a consistent downslide. And as you can see, obviously, it went pretty much almost basically to zero on the 10-year, because this indicates tracking growth, right? So that's what the 10-year kind of. So the 2 year is controlled by the Federal Reserve. The 10-year effectively tracks what expectations of future growth are. Um, so it's been on kind of a slide as like population declines and just different factors have gone into this. Debt has weighed on GDP, that kind of stuff. Interest on debt. Export markets, like as we exported things, or as we started importing more than we export, that kind of stuff. It all just kind of weighs down. So what's going on is basically everybody was waiting for, and that's what kind of happened this week, is everybody was waiting to see if the 10-year would break through its historical trend line and keep going up. So the problem here is that if it keeps going up, and it kind of did it right, and you can literally see what's going on. Every time that it hits these peaks, it goes into a valley, and this is typically, and you can see when these valleys occur, and they're kind of big if you really think about it. Um, so this is kind of like great financial crisis area right here. It was kind of going back up, and then it started to weaken again a lot going into the election. This is COVID, Trump presidencies kind of stuff right in here, and then you can kind of see what happened. So if you kind of draw this out, you can start making kind of educated guesses on when you think when you think a recession might occur. Um, right now, consumer data is just collapsing, just completely collapsing. We're in what would effectively be called the demand destruction phase of an economic cycle. What that is so not only has oil weighed on the ability of people to buy stuff, so now you have inflation. And you can go to literally any Walmart and check this out and see just go to the pizza aisle, for example, and you can kind of see things are just kind of like just sitting there. Like products are just kind of sitting on the shelf. And this is at a time when companies thought that the economy would kind of keep going up, and so they started to adjust the supply to meet the demand. Finally, they started to do this because you can see it in the inventory numbers as the inventories are starting to build. This is at a very bad time because what that means is that companies are going to have a lot of inventory sitting there when demand from consumers is effectively collapsing at the moment. Well, why is demand collapsing at the moment? There's another chart I could pull up if I wanted to, but it's the chart that I'm sure everybody's seen where it's mortgage rates are hitting 5% now, headed towards probably 5.5%, possibly 6%, um, as the market has very, very quickly priced in a lot of rate hikes. Um, so what's going on right now is the market is getting pulled in multiple directions. So these different So previously, when rates were at zero, nobody really cared if a Federal Reserve official got on TV and said anything. The only time they cared is if the Federal Reserve official said something about like unwinding their stimulus kind of stuff. But we had effectively 10 years of them not doing that, right? And now they're forced to reverse course. Well, the problem is that they all get on TV and say different things, or they say one thing in one interview that'll make it sound like, yeah, we need to just keep raising rates until we break inflation, which would break the economy. Or then they will get on TV, realize they screwed up, because this is exactly what happened the other day. Brainerd, one of the Federal Reserve members known for being a dove, not wanting to raise rates, got on TV, said that she wanted to raise rates a lot. Well, all of a sudden, the 2 year took off very quickly through the 10 year. Very quickly through the 10 year, and the yield curve inverted. I mean, the 2 year became more valuable than the 10 year. She then had to get on TV and effectively, the next interview she did, she kind of sounded like a dove. So it all reversed. And then all of a sudden, the rates went down, the market went up. Then John Williams the other day, the vice president of the Federal Reserve, he effectively stuck to the script. We're going to have to do our meetings. We're going to have professional conversations. We're going to stick to the data, that kind of thing. But he said something that really upset the market, and you can clearly see right here is that they are going to keep. He effectively said they're they're going to keep going until they get inflation down to 2%. And right now, if you look at the headline, the big one, it's at 8.5. So to get that down, but he said they're also going to try not to cause a recession at the same time. Because that's the very next question that came out the guy's mouth. Um, there's far too much of a chance that they just screw this up. Like rates are, especially like if you have people that rely on like flipping houses right now, they're clearly seeing the pain. Like you can clearly see market values of houses are starting to drop hard, just in the last month alone. Um, in some areas where there's high demand, they're still going up. It's like people as competition is going away and supply is going down, but the housing market is kind of going into a free fall very quickly. And this isn't a situation where you can just turn it around kind of thing. You can't just snap your finger, say rates are zero tomorrow, and just fix this. Actually, they actually do still have time to do that, but right now they're not going to do that. So right now rates are going to stay higher for a very significant period of time, well into next year, until inflation goes down, because food inflation is out of control at the moment. Um, and you can kind of see like just the inflation report came out showed that gas was seriously weighing on the last inflation report. So if you have a fuel efficient car, you're not really feeling it right now. You kind of are, but not nearly as much as somebody who's driving like a very big truck, like nowhere near. Um, so you can just kind of see these different things that are weighing on the economy. So that's effectively, so right now, this economy is run by the consumer, and consumer demand is collapsing. So that's why I decided to take my profits and get out while I could. Um, so you can see it in different things. So I had energy, for example. I'll do a quick review, and you can still see energy still going up. I sold it probably too soon, but you can see what happens here. When people are expecting a recession, they go into safety. This chart movement is not normal. This is not how this is supposed to work. Like when you see this kind of chart movement in utilities, it's a really big red flag. So as you can see, leading up to where it collapsed in COVID, um, like right about here, it started spreading in China. The people in Europe, China, that kind of thing, like the foreign investors, they knew it was going to cause a global slowdown, so they rushed into safety. That's what this is. This is a rush into safety. What we're seeing right now is you can kind of see these when they think like, okay, so this is the original COVID wave in here, and this is all the vaccine talk, all that kind of stuff, and then like you can see when the vaccines came out, like, oh, the economy's going to be great again. We got all this stimulus, and then boom, we got all this stimulus, and all of a sudden utilities die out. Well, all of a sudden the stimulus starts to wear out, inflation's eating, rates are going up at a crazy rate because rates didn't go up at all here. They were they were still flat. I mean, they had started talking about buying bonds again in here, but utilities went up, and then you can kind of see as people start to think this thing's going to fall apart and we're going to see like a drop in the market, you can kind of see people rush into safety. You see what they do immediately afterwards, right? As soon as it actually does fall, like this thing hit a, so this is energy, for example, just one example, but like it hit 135 and then it just dropped like a rock down to 79, and then it took quite a while to recover. So you can kind of get a general idea. Another one that you could watch, this is behaving differently this time, or a little bit differently this time, but you can kind of get the general idea. The bond market is effectively breaking at the moment. uh, like you can really see, like the bond market is effectively breaking right now as people are selling treasuries. This is a fund that holds longer term debt. I think it shows the dates on here, but I've shown this before. Their portfolio is basically bonds. Um, so you can see people pile into these, and then when they think that we're actually going into a recession, they start going to cash. So you can kind of get a general idea of like these things. This is acting a little differently this time. Verizon's another one. Verizon's hitting levels that I haven't seen it hit in quite a while. Um, but if you go out to the 1 year, you can kind of see people are starting to go into dividend stocks to look for safety. Um, they kind of start doing this when they think that there's going to be a recession or something's going to happen. My guess, recession, or the official recession, I guess if you want to call it that, is maybe beginning of 2023. It starts still. But I mean, prior to the recession, like if you could just look at this market right now, I see nothing that's going to make this market trade up. Um, you might be able to catch the bottom on the NASDAQ, maybe, but anything you invest in right now is probably going to be negative by the end of the year. There's just nothing you can do. That's just how this market is. So you have to have a different view on the market. So the view that you have to have right now is effectively, what am I going to get that once we get to the other side of this, like so say here's COVID for example, like what am I going to own like going in, maybe 3 years probably a better example, like going into it, you can see how it kind of trades flat, but this is when the Federal Reserve was raising rates in 2019, and like but then they started to ease towards the end of 2019 going into 2020. But you can see the market just kind of, this is the market just literally flat. See how it's negative? And this should be a red flag to anybody who's trading right now. This is April of 2019. This is before COVID, before all of that, but the Federal Reserve was raising rates, or trying to raise rates, but failed spectacularly. But the market was effectively trading flat because there wasn't no stimulus. And you can see it right here. Like, look, we're from April, and you look at the NASDAQ, 0.17%. We're into August. It's down still. September, we're up a little. Just straight up flat line. I really do think, like, once this line plays out for the rest of this year, that's what this market's going to actually look like until you get to this. And then when you get to this point right here, this is the big drop. This is when the big boys come back in. The people that are holding treasuries right now, that are hiding out in bonds, this is when they dump all those treasuries, or they dump all those positions, or the cash positions right now. Like, the cash positions probably on a lot of these firms is probably massive right now, like just completely massive, waiting to pile back into this market. But when we hit this point right here where it stops trading flat and it kind of goes up a little bit, well, it goes up a lot, as you can see. It shoots up. This is called the melt up, and then it just dumps. But where do you want to be on the other side of this? So, like, where do you want to be positioned on the other side of this? And the obvious answer, I think, probably is in tech. Because the first thing that the Federal Reserve will do is they will take interest rates and they will nuke them down to zero. Very quickly. Like, very quickly, you will see this go to zero. Right now, they have a little bit of room, but you're going to start to see it. By the time they start to cut rates, it's already way too late. Like, by the time they start to cut rates right here, the economy is already in a free fall. They know this. So you'll see them just take this rate probably down to zero again. And what that means is that the NASDAQ is probably going to shoot up like a rocket. So what am I doing at the moment? I'm really am considering, probably come Monday, taking probably 10 grand of this and just drop it in QLID. Just this massive return thing that they got going on. This is a fund I've played with for a long time, been in it, watched it grow. This fund used to only have like $1 billion in it. Now it's got $7.1 billion. That's not just small investors piling in there. That's like major investors. This is a big one that everybody jumps into, but be aware. Like, just be aware. The chances that this right here, this negative 1% says negative 10% by the end of this year is extremely high. Like, it's extremely high. But if I take that 10% or that 10,000 and put it there, if you take 10,000, you can just look at it. Divided by 20.59, that gives you 485 shares. And then the dividends right here, 0.21. It's extra $101 per month. And then times that by, say, the remaining amount of the time for the year, you get 814, obviously. So instead of missing out on $814 worth of dividends that I could use towards bills, anything else, building up some of these other positions in here, I decided I'm just going to dump it. So I decided to drop probably about 10,000 into there. I sold Verizon, Energy, and a few of those probably at I don't know if they're highs. I don't think they're highs, but I think they got a lot of room to run. But the problem is that it's kind of like the game of musical chairs. It's like, who's going to be the last one out? Because you're not going to be as fast as the computers, and it happens quick. You can clearly see on that chart that I showed for energy. Like, if you're sitting here, you're sitting here, you're this guy right here, and it does that first dump, all of a sudden your investment went from 130 on February 10th to 2 weeks later, it's at 113. And then, what is that? Maybe like a week later? Oh, it went up a little. So you think, oh, everything's fine now. And then all of a sudden, you get the actual day that it dumps, and now all of a sudden your investment went from 116. And it happens quick. This is a period of maybe 9 days. But you don't want to be here in this 9 days, especially when it starts to drop. Because if you sold it right, this was your last chance to get out right here. How would you know that? Like, this is March 2nd. This is your last chance to get out and make a profit before it drops to 79. And then you're forced to hold it and reinvest the dividends or whatever. And then there you go. You're at 86, but then it takes like 2 more years and another recession for it to actually go back up to something that's actually, you can brag about on a screenshot. So I think that's why I got out now. Just took my profits, moved to the corner, and then just going to drop it into something that I know is going to pay me dividends. The goal here, at least with what I'm going to do with QYLD, for example, is I am well aware this will be down probably 10% by the end of the year. Like, I am well aware that going into the recession, but what I'm looking at is what's on the other side of the recession. Like, what's on the other side of the recession. So this is probably this is like the bottom of COVID right here, the worst that it could get. And they've dropped to 1722. So if it drops to 1722, right now, and what's that, 83 minus 100? So that would be a 17% drop. So that's entirely possible. So that's like you have to just this goes out to anybody. Any money that you invest in the market right now could potentially be very negative by the end of the year, especially if the Federal Reserve does not reverse course. If they reverse course and they get scared because the market starts to drop, we could be okay, but I don't think, because I'm thinking long term, probably 2 5 years out. So that's why this investment makes sense for me and what I did makes sense. But right now, just be aware, don't expect massive profits this year, because even like I showed for 2019, they were raising rates all into 2018, realized that the market was completely starting to fall apart in December 2018, drop rates by a lot at the end of 2018, but for the entire year of 2019, it traded completely flat. like until it went up a little bit and then it just tanked. So we might get one more rally out of this, but that's your rally where it's like that's your last hoorah. So as it stands right now, this is where I'm positioned at going into Monday. Like I said, probably just going to drop it into QYLD, take my profits, ride out the wave when it does drop, because I'm well aware this thing's going to tank at some point. I don't know when, but nobody can predict that. Nobody can predict that. But on the other side of it, they're going to drop rates to zero. I already know that's coming. And then they're probably going to be asking the government for another stimulus. So this is where I'm at right now. Debt's been completely wound down. You'll see that, obviously, not only with the market that's been bad the last 2 weeks, but you'll see that with the difference in the numbers here. As you can see, so this is the number that goes on the video. So this would be 51, but this is completely gone. I've wound it down just to completely no debt at all, so that on the other side of this recession, I will have a lot of capital power to be able to put money to work, so that when this thing completely, whatever falls apart, I'll be able to move back out of these positions here. I'll probably move out of a few of these positions back into things like more traditional dividend-looking portfolios, like Verizon, that kind of stuff. So, but that's where we're at right now. Risk of recession is probably still like a yellow light, if you want to call it that. I still think it's 6 to 12 months out. But I think the market trades flat, and then at some point, I'm not sure when, it goes up, and then it's just going to drop. Unless the Federal Reserve does something very different. But even then, the consumer destruction right now, demand destruction from just inflation, is just amazing to see right now. Like, just amazing to see. And if you go out there, you can see it. Just walk around Target, just walk around Walmart, and just walk. You can see just things are just sitting on the shelf. So yeah, let me know what you think in the comments. Like I said, I'm gonna keep making videos, even though they're gonna be just kind of boring, I guess. But just my thoughts on the economy. But that's kind of where we're at right now. Thank you so much. Bye.